Welcome back to Money Matters. I'm Emily Johnson, founder of Polaris Capital Advisors. Today we've been addressing the topic of risk. And as exciting as that is, it actually sounds exciting. In movies, risk is really exciting. In your financial life, risk is not always that exciting. But I thought since we discussed the different parameters around risk and how you might actually see it addressed if you're looking at your accounts online or if you're looking, if you're talking with your financial advisor, I thought I might actually address sort of some frequently asked questions that I get from people when it comes to risk and when it comes to sticking with a financial plan. One of the questions that I get from new clients, and people will call in and ask this, is what is your average return that you achieve for clients annually? Well, first of all, I'm not allowed to answer a question like that because the SEC doesn't let us answer it. But it's also an impossible question. And it's not because we're circumventing that. It's because each client has a different risk tolerance and each client has a different need. So I would be remiss, and I was just sitting down with some clients this week that are in this situation, I would be remiss if I said to them, you know what, I think that we can actually aim for, because you're willing to take risk, you can stomach that risk, I think we should aim for sort of a 16% return and the risk that goes with it. Those clients don't need to take that kind of risk. They don't need to take that because their objectives are in line, they have plenty of money saved up. They don't have to take that kind of risk. They don't have to go through a bad market and realize that maybe they can't stomach it. So for those clients, their returns are actually going to be lower. It's not fancy, it's not flashy at all, but their returns are going to be lower because we don't have to take as much risk. So they're not going to have a lot of movement in their accounts on a month-to-month basis. Hopefully, of course, they go up, but it's probably going to be at a much less volatile pace, or it's going to look much less volatile than it is if we were investing for a much higher return, because with those higher returns are going to come higher volatility, higher risk, which means when the market goes down, we're going to go down more. This is not just a one-sided up chart. So that is one question that it's a very fair question. And of course, because we've been conditioned by the financial markets and by advertisements to make us feel like we should be looking for an average of 8 to 10% a year over the next 10 years, that doesn't necessarily always happen. It's really going to be based on what you can stomach and whether you can stick to the plan. We no longer have 8 to 10% interest rates that give us those kinds of coupon clipping guarantees like we did 50 years ago. We're looking at a much different market now. So when you ask that question, if the person that you're asking the question of says to you, well, we really need to address what your risk profile is before I could give you that answer, that's the kind of answer that you really want, because you know then that that person is really looking out for you, your goals, and what your plan is, as opposed to just throwing out a number to try to impress you. If they throw out a number to try to impress you, chances are they're not going to be looking out for your objectives. They're going to simply be running some sort of a model that's based on whatever their interests are, whatever the company is that they're working for, lots of different types of investments, etc. But they're not necessarily going to be looking at your specific plan. They could quote you what a Morningstar return is for a specific mutual fund, for a specific ETF, but they can't necessarily quote you what their returns are as an investment advisor on average for clients. So that's definitely one of the more common questions that I get. Another question that I get is, if we're looking at this chart here. So again, this is a bond allocation, this is a stock allocation, this is a cash allocation right here. So this is pretty simple. So in our equity allocation here, and again, this is based on a higher risk portfolio. You might, if you have a lower risk portfolio, you might have more blue in here. But within this, you're going to have small cap, large cap, international. Within the bond section, you're going to have short duration, intermediate, long duration. And then you also have alternative investments and things like that. Our industry focuses so much on what's in each of these individual sets of the pie and really doesn't focus enough on saying to the individual, hey, with all of this stuff fitting together in this specific pie, if your return was 33% down in the Great Recession, would you be able to stomach it? That's really what we need to be focused on, not necessarily what each of the pieces of the pie are. But that's one of the questions that I get the most is about, do you use mutual funds or do you use exchange-traded funds? Do you use models? Do you use what we call separately managed accounts? Do you use specific equities, large cap value? What kind of research do you follow? our industry is so conditioned on focusing on each of those individual issues. Which hedge funds do you like? Which private equity funds do you like? Whatever is flashy at the time, exchange-traded funds, actively managed exchange-traded funds, beta. I mean, all these different terms that you see, you can just get inundated with it. And my clients that are constantly asking about that, I try to dial it back a little bit so that I make sure that they understand the overall picture before we really dig into each of these individual slices of the pie. And the reason is because, and there's a lot of research behind this, and if I was better with technology, I'd have this slide up here too. The reason is because based on a study that was done by a group of actuaries, only 2% of your success in achieving your retirement goals, and you could actually insert any goal in that. It could be education planning, it could be buying a car, it could be buying a house. Only 2% of your success in achieving that goal is based on the specific investments that you choose. But we spend all of our time focusing on the specific investments that we choose because that's what sells. So that's what you see the most of when you're looking at NBC, CBS, any of the news broadcasts that have commercials with some of the big fund managers, because that's really what sells. So before you start asking questions like that about the specific investments that are inside, and yes, it's very important. Obviously, cost, tax efficiency, all of those things add up. Plenty of studies about that too. But make sure before you start asking those questions that you're answering the question of what's my overall plan. A perfect example of this is some fantastic folks that I work with that hopefully they'll recognize themselves actually. And whenever I sit down with them, and interestingly, sometimes I have to sit down with the family separately, the husband and wife separately, because they sort of have different objectives. Whenever I sit down with them and I say, what are your objectives when it comes to these investments? Or when are we looking to retire? Well, I usually get the question, well, how much money can I get out of my investments? And I say, well, we need to know what the time frame is, and we need to know, are you going to continue contributing? Are you going to be working part-time? I really need to know how much money you need. Are we looking for $60,000 a year in expenses? Are you going to sell your house? And the answer that I get every time is, well, I don't know and I don't want to ask. They literally don't want to know how much money they spend. They don't want to know how much money they're going to spend in retirement, and yet whenever we're talking, which is pretty frequently because I know that they're looking to pull the trigger on this, the question is always, how much money can I get out of my investments? So I just say, okay, well, you know, we'll pull up something, and this is how much money you can get out of your investments in this year, and in this year, and in this year, based on these variables, and then we have the exact same conversation the next year. It is so real, and if you can identify with that, you're in really good company because that happens all the time. And the point of that story is not necessarily to highlight the flaws in our industry. It's to really highlight the fact that the key to a plan is knowing what your objectives are. And if you're really going to make the most of putting together all of the investments that you have, saving the money that you've saved, that you've worked so hard for, you really need to know what your objectives are and what you're looking to spend. So before you ask your financial advisor, how much money can I get out of my investments, have an idea of what your needs are, because that's going to help them much better align your investments with what your goals are. And that's what it's all about. It's all about you at the end of the day. And it's up to your advisor through trust, through leadership, and through inspiration to hopefully guide you towards that particular goal. So those are 3 questions that I get pretty frequently. And then the last one, because we're running out of time, has to do a lot with interest rates and with bonds. And specifically, if we had a lower risk portfolio that had significantly greater bond allocation in it, what does that mean? Because right now those bonds are yielding not a whole heck of a lot. And also they do actually hold inherent risk if interest rates go up. So when we look at portfolios now, even though historically bonds have definitely taken the risk of a portfolio down, sometimes now we do need to keep more funds either in cash and sometimes in alternative investments in lieu of bonds because of the inherent risk that you actually see in bonds. So this is kind of getting into a little bit more of the detail here, but that is a very common question that I see when we get to this chart of, well, should we actually have that large bond allocation? And the answer very well might be no. If we're going to keep our risk at X level, we might need to change out some of the bond allocation for something slightly different. So that basically covers what I wanted to address today when it comes to how to assess risk in your portfolio, how to address it with your financial advisor, what to look for when you're looking at your accounts online. It's not just about the number on your statement. It's about the long-term plan and making sure that you stick with it. So Until next week, please shoot me your thoughts, comments, concerns, issues. Give me a call. I love hearing from you, and I love your ideas for the show. So until next week, this has been Money Matters. We'll see you soon.